Pathway to 17 Summit. Good day, good afternoon, good morning. You're at the Women's Financial Inclusion trains over the last decade with myself, Tariro Nyimo. I am a CDFP program lead at DFI, and Yasmin bin Humam, who is a financial sector specialist with CGAP. I'll start by introducing her. Yasmin works on analyzing excluded segments to more closely examine who remains financially excluded and how financial services might impact their lives. She also serves as a focal point for CGAP's gender mainstreaming and facilitates an industry-wide community of practice on women's financial inclusion. Welcome, Yasmin, and thank you.
Thanks for having me. I'm looking forward to it.
All right. So we'll start off by playing a pre-recorded presentation from Yasmin, and then we'll get into an interactive session. So let's move to the presentation.
Hello, everyone. I'm very glad to be here today. Thank you to the Alliance of Digital Finance Associations and to Digital Frontiers Institute for inviting me to engage on the topic of trends in women's financial inclusion. My name is Yasmin bin Humam, and I'm a financial sector specialist at CGAP and the program manager for the Finequity community of practice on women's financial inclusion. I firmly believe that gender equality is not just the Sustainable Development Goal itself, but that gender equality is central to achieving all of the Sustainable Development Goals. Before I touch on the trends in women's financial inclusion over the years, I want to illustrate the point of how important women's financial inclusion is to achieving the Sustainable Development Goals with a few call-outs. On the goal of good health, we know that women's financial inclusion has an impact in this area because women have been shown to reinvest up to 90% of their income in their children's health and education. When it comes to health shocks, surveys show that women consistently find it more difficult to come up with emergency funds than men, and that women have lower rates of access to insurance. On the goal of quality education, in Nepal, studies have shown that women's access to savings accounts have led to improved education levels and higher professional aspirations among their daughters. And on the topic of good jobs and economic growth, a groundbreaking study in India has proven that among women who had worked for the government's Guaranteed Rural Employment Scheme, those who received mobile accounts, together with training on how to use them and direct payments into their personal mobile wallets, were more likely to have worked for pay in the past year, including in the private sector, and were more likely to report higher earnings because of the control these personal accounts afforded them. So the topic of trends in women's financial inclusion is very broad and very varied. And for this reason, I hope during this session that you will contribute using the chat function to highlight your own perspectives and experiences. It will make everyone that much more informed rather than just listening to me alone. And my colleague, Tariro Nyimo, will be monitoring the chat closely and will draw on it for the interactive session to follow. I will touch on these three topics. The first is trends in women's access to accounts. The second is trends in women's digital financial inclusion. And the third is not a historical trend, but rather a trend that we will need to keep an eye on in the future and which I implore you to study in your course of work. I should mention that social norms are a central factor in women's financial inclusion, and CGAP has published a technical guide on the topic of diagnosing norms, but I will leave this as a topic for the session with Alex Kessler, which I hope you will attend. So when it comes to access, the trends I have observed have been that on the global level, an ever-increasing percentage of women own accounts, not correcting for dormancy. 59% of women had accounts in 2017 versus 30% in 2011. But worth noting is that the gap in accounts between men and women persists stubbornly at 9 percentage points, virtually unchanged over this period. Similarly, looking by region, we've seen advances in absolute numbers, but stubbornly persistent gender gaps. Here I'm citing statistics on accounts with licensed financial institutions, rather than simply accounts, which is a much broader concept. And as of the last Global Findex in 2017, the Middle East and North Africa region had the largest gender gap with 17 percentage points. Sub-Saharan Africa and South Asia both had 11 percentage point gender gaps. Now, the East Asia Pacific region has the highest rates of account ownership at a financial institution at 70% and the lowest gender gap at 5 percentage points. But looking at country-level trends, we definitely see that there are some large gaps masked by the regional averages. So bear with me as I highlight some of these numbers. In Bangladesh, 65% of men have an account against only 36% of women. In Pakistan, 35% of men have an account, but only 7% of women do. In Zambia, 53% of men had an account, compared with 40% of women. In Ghana, 62% of men had an account, compared with 54% of women. And in Jordan, 56% of men had an account, compared with only 27% of women. Now, despite having highlighted these statistics, I want to make it very clear that we often don't have the data to sufficiently track women's financial inclusion trends on a consistent and granular level. The Findex survey is conducted every 3 years with a statistically significant but small sample size and has stalled publication of its latest findings in the face of COVID-19. In 2017, only 27 countries were able to provide the gender breakdown of commercial bank depositors and borrowers to the IMF. Among these were India, Pakistan, Bangladesh, Cameroon, and Uganda. So kudos to these countries, and if there's anyone in the audience from them. There are many, many data initiatives underway, though. So I have cause to be hopeful that in future we will be able to tell a narrative of women's financial inclusion accurately and at the community level. To give some examples of positive trends, in Nigeria, the government collects demand-side data through its Afina Access Survey, which is nationwide, covers over 20,000 consumers. The survey is conducted every 2 years and most recently highlighted that 32% of men are financially excluded, compared with 40% of women. Access Bank, one of the largest banks in Nigeria, has adopted a strategy that allows multiple business units within the bank to offer products and services to target segments of women. And with its targeted initiative, the bank has brought in 15.4 million new women clients, and women represent 34% of the bank's portfolio. And the bank intends to increase that number to at least 45% by 2022. So if you track gender disaggregated data as part of your operations, please share your successes and challenges with us in the chat. We'd love to hear from you. Turning to my second theme, that of digital financial services. It has definitely been a boon to some women, giving them access to financial accounts. So for example, in Cote d'Ivoire, men are twice as likely as women to have a bank account, yet women are just as likely as men to have a mobile money account only. And in Kenya, 70% of women had a mobile money account in 2017. But digital is not a silver bullet. The expansion of digital offerings has exacerbated the financial inclusion gaps in certain contexts. And I'd like to read you this quote from a village elder in India. Young girls get misguided with cell phones. It can break families and ruin relationships. Why do girls need a cell phone? The internet is a waste of time and money for a middle-class community like us. Girls should better utilize their time for study and other works. And this village actually banned cell phones for unmarried women, while men are given free access to technology. So how's a woman going to use digital financial services if she cannot even have a phone? Ultimately, though, I feel that women's digital financial inclusion is a trend that will continue to increase. 83% of women across lower middle income countries now have a mobile phone, and 58% use mobile internet. So there are policies and market forces that have driven and will continue to drive this trend. The first is the digitization of government-to-person payments. Governments have found that this is very efficient and has lots of cost savings. Now, of course, it's only possible where there's sufficient digital infrastructure in place, but the incentive is there to build such infrastructure. The second is wage digitization, which has had a lot of success in Bangladesh in the garment industry, but we also see it among government employees, and increasingly there are efforts to digitize agricultural supply chains. Thirdly, of course, the story of M-Pesa is legend, but even beyond that, we see women's uptake of person-to-person payment services in order to send and receive money amongst family and friends. I'm going to spend a bit more time on the fourth trend, which is one that is more recent, and I've called it out separately because it is an area of study for CGAP. And that is women are able to sell goods and services or act as intermediaries, delivery people, or suppliers to online commerce platforms. Now, we still see that women are concentrated in particular sectors. Nonetheless, women are paving the way for one another in areas like ride-hailing as well. Informal online commerce, which you see on the slide here, is a phrase that CGAP has coined to describe women buying and selling products and services using social media platforms like Facebook and WhatsApp, often initially among their personal networks, and then expanding further. Now, we don't have quantitative data on this, and it seems to be largely cash on delivery based, but stakeholders are taking note of this phenomenon and no doubt will begin to design for these use cases, both in terms of digital payments and digital credit. Now, if any of you have experiences with these on-ramps or think there are additional ones that I have not mentioned, please share your thoughts in the chat. The final topic I'd like to touch upon is a trend that has remained insufficiently studied, and that is the topic of risks and how they affect women. Consumer protection and privacy cannot take a back seat, especially not for poor women who stand to lose so much if things go wrong. Now, CGAP has a risk typology that is forthcoming, developed by my colleagues Marjorie Chalwe and Eric Duflo. So I hope you'll keep your eyes out for the publication. But what I thought would be useful to draw attention to are these three dimensions which have been touched upon by various stakeholders in the sector and which CGAP's research calls out. The first is that women risk being crowded out by algorithmic bias. As women are either excluded from the digital world or use digital services in ways differently from men, their data trails tell different stories, which the algorithms for credit, marketing, and other features may not take into account. The second is that with lower digital literacy rates, women are susceptible to fraud and identity theft when using financial services. And the third is the trend of women's reliance on agents, which can prove to be a double-edged sword. On the one hand, such individuals open the door for women to engage in the digital financial ecosystem. On the other hand, they can abuse this position of knowledge and trust if women are in arrears in payments, for example. So if you have insights into how stakeholders might track and mitigate such risks to women in future, or other risks arising from digital financial service use, please share them in the chat. I'm going to end now with an invitation to all of you to join FinEquity, our community of practice on women's financial inclusion, so that you can continue the conversations way into the future. Here on the slide, which you can see our various sign-up options, and we have an annual meeting coming up on December 8th, which is detailed on our website. And with that, I will turn it over to Tariro, and I look forward to engaging in the question and answer session. Thank you.
Well, thank you, Yasmin, for that presentation. And I have shared the link to FinEquity, and hoping to see all our participants there at the annual conference that we're having. So, Yasmin, that was such a great presentation, and thank you so much. I think you touched on, you started off with some call outs on SDGs. You went into women's financial inclusion, access data. You touched on digital financial inclusion, and then ended up on risk. So much has been said. And I know that there was a comment from Kombe about digital identity and how that enables women's financial inclusion. Would you like to at least expand on what the trends are regarding digital identity and that being an enabler for women's financial inclusion?
Sure, absolutely. Digital identity is key to opening digital accounts, and we've seen this bear out in India. We've seen it bear out in Pakistan, for example, with the Benazir income support. I'm not saying the name correctly, but for the income support program in Pakistan. It's a challenge to onboard people digitally. Obviously, there's an initial entry point for getting the digital identity, into the system. You have to come with certain documentation, but it allows for it allows for easier tiered know your customer requirements, and I think that is what has been crucial in including a lot of poor women in the financial system. The fact that there are tailored accounts that perhaps have, limits on them in terms of the amounts that they can hold. And so they have lower know your customer requirements, which the poor can more easily meet. And I think this has been a big driver of financial inclusion around the world. I know you yourself are a digital finance professional. Perhaps you also have experience with this, or perhaps some of the other people in the group have experience with this. And I'm not able to see the chat, but I think everybody else is. So people should share their experiences nonetheless.
Yes, and I think a few people have been sharing their experiences, not so much on digital identity, but also on the data and the data trends in the different regions, which you touched on. For example, in sub-Saharan Africa, the gap is lower than possibly in the Middle East and North Africa. But within sub-Saharan Africa, there are also different types of gender gaps there. And I would say that I think from Southern Africa, where I'm from, even there are more included people, I think 43% of inclusion. But the gender gap itself, it differs in different countries, for example, in Zimbabwe and in Kenya. And you did talk about account ownership and how that's different from really a broader way of talking about access. Would you talk about those trends in the different regions when you include the broader aspect of account ownership?
Sure. Of course, the challenge is that once you have greater numbers, it opens you up to greater gaps, right? If only 10% of people are financially included, that only leaves margin for small gaps, right? So as progress is made in financial inclusion, particularly among men, it opens you up to larger gender gaps. But perhaps the silver lining of that is that already it means that, there's an infrastructure in place, and that women can catch up, and be included with the right policies and with the right targeting by financial service providers. I think there's also a very large, actually, urban-rural divide in terms of financial inclusion. And we know, that oftentimes women concentrate in rural areas, and that this is also a part of the story that we need to explore. We need to have these more nuanced conversations. It's not just how do we include women writ large, it's, how do we include rural smallholder farmer women, how do we include peri-urban women who are working, perhaps in market stalls or whatnot. So a lot of the intersectionality of women's identities is driving these gaps, I think.
Mm-hmm. Okay, and then you moved on to risk, and that's a very interesting point that you highlighted on the trends. And you talked about agent networks being a double-edged sword. In our participants, we've got regulators, we've got fintechs, we've got bankers. All of those stakeholders do work with agent networks, and they're building or regulating agent networks. Can you give us more information on how we need to balance it out when we're pushing for digital financial inclusion and then trying to reach women, possibly rural women who are in remote areas using agent networks, at the same time trying to scale up using digital, and managing those costs? How do we where do you see the future? What is the trend?
Yeah, it's a great question. And I hope that others are, with experience who perhaps work directly with agent networks can weigh in with their experiences in the chat in Swapcard. Because largely what I'm citing is, studies that have been done, or things from conversations with providers. But with agent networks, the agent is so often the onboarding point for women. And on average, we find that women need more information, to begin to start using a service. They're perhaps less trusting, and so this obviously is more time, more effort on the part of the agent, and they might be disinclined, to spend that time without guarantee of return. But what studies have found is that women make loyal customers, and that they are profitable customers. They perhaps transact in lower amounts, but they transact quite frequently. And then they branch out into other services by the same providers. They tend to stay with the same provider for longer. And so I think a lot of research and education around these trends, around the business case for serving women, and sharing that with agents and making agents part of that process will be crucial to motivate agents to reach out to women customers. The other portion is, experimenting more with women agents. Consistently, we find, that women are underrepresented in agent networks, and that not always, but there are many instances where women would prefer to act with another woman as her agent. And so that can go a long way in women's financial inclusion. And then the third thing I'll mention is, the accountability of the agents. People are often, and women in particular, are often fearful that they might make a mistake, or that they might be defrauded. And so you really have to build up that trust in the agent network, hold agents to account, if PIN numbers are misused. And women are more likely to hand over their PIN number, hand over their contact list, all these kinds of things, because they have lower rates of digital literacy, and they rely on the agents more. And so we really need to put the regulations in place to make sure that those agents are held accountable if things go wrong.
It's so true. There are different levels of digital literacy amongst women in different regions as well. Some women, like you said, prefer to be helped by a female agent. And some women really just need help and just need that human connection when they're transacting. So that gives them more confidence. So that balance of both digital and agent networks works in promoting women's financial inclusion. The other thing that I am very interested in that you talked about was, I think it's risk and AI. I think you talked a little bit about AI. And so when we're doing this alternative credit scoring and we're trying to give access to more women or entrepreneur or informal trader women into the financial system, giving them access to these microloans or microfinances so that they can expand their livelihoods or improve their livelihoods, we get out the use of algorithms and algorithm bias. What is there a lot that has been done through your experience and in your research, what you've seen so far on these algorithms and how fair they are? Because then algorithms themselves might introduce even another layer of bias that excludes women or some women.
Absolutely. No, the Center for Financial Inclusion has done a great study on algorithm bias. I don't have the link handy, but perhaps we can share it after the fact. it's definitely there. It definitely exists. You know, I think it's driven by the fact that the data is simply incomplete, you know, for women. And so how can you build an algorithm that doesn't include data on the things that, you know, that women are doing? Perhaps they transact less, you know, perhaps they don't send particular types of transfers. They send more to friends and family rather than business transfers. But that doesn't mean that those aren't business transactions, you know, between friends and family. You know, how are we interpreting the data that we do have? I think we don't have enough women working in the data sphere, in the algorithm sphere, in the fintech sphere. I think that's a big problem that's driving this bias. If there are any women in the audience or thinking about a career in fintech, I would say go for it. We need you. You know, how to correct for this? It's a challenge, but if you know where to look, you know, things can be done. If you get creative about the types of data that you are including, you can see different results. And I know that CGAP has had some luck with this in credit scoring in Tanzania, shadowing a particular provider, and Women's World Banking has done work on this. So it's a growing field of study, you know, the algorithm bias, and I think we're well on our way to finding our way around it.
All right. Thank you, Yasmin. There's a question, and this will be our last question, from Rochelle, and she's talking about women starting their journey via social media and other platforms, and how we can create an environment that empowers them to become founder of their own businesses and obtaining that venture capital funding.
That's a great question, because this is a trend that, you know, has been I think quite prolific, but invisible to the donor and the venture capital, you know, community. And that's why, you know, CGAP published its publication on informal commerce. Some women do start on social media. Actually, a lot of women use social media to enhance an existing business that they might have, either brick and mortar or on some kind of other platform. So there is a big mix in the business models, and I think we need more research to figure out what the different business models are in terms of how women use social media. It's difficult to track because it is informal business, right? Oftentimes these businesses are perhaps not registered, you know, but when they are, I mean, what drives venture capital? It's the numbers, you know, you know, it's the numbers. So we just need more data on, you know, the number of women engaging, their, you know, profitability rates, their growth rates. Is this a long-term business model, or is this kind of social media business a stepping stone to some other kind of business that would then be venture capital funded? Because venture capital is usually quite large amounts, right? I mean, you have other ways of crowdsourcing funding for entrepreneurs, you know, that are smaller amounts, you know, but once we have the data, the question is who gets the data, right? So if there are donors and researchers in the audience, I'm looking at you, and I'm hoping that you'll train your lens on this phenomenon.
All right. Thank you so much, Yasmin, for this session. Thank you for the great presentation. And yeah, we need more data, more and more data.
Absolutely. Thank you very much.
Thank you.